Hello, everyone. I hope everyone here has had a chance to grab a drink and a snack and is ready to settle in for today's Sip and Solve. Today, we will be talking about alternative data in credit decisioning. My name is Emily Garrett. I'm an analytics consultant with Experian on our commercial data sciences team. And while the weather would suggest an iced coffee, I just haven't been able to get into them, so I'm sitting here with just a regular old hot black coffee. In researching this topic, I found the following quote on a Small Business Administration website in a paper they presented. In summary, the writer points out that a lot of small businesses struggle to obtain loans because they are young and have little credit history, what we might call thin files. When lenders can't get enough information, they are reluctant to lend. Hence, the SBA is necessary to help mitigate some of the risk. Today, however, we're going to talk specifically about the difficulty in obtaining enough reliable information to estimate risk so that an underwriting decision can be made. What are the implications if businesses can't obtain adequate credit? Well, all of the things you might expect. Businesses might have a successful business plan, but especially early on, may not have adequate working capital. This leads to several issues. An inability to expand where businesses are not able to invest, especially in people in this heavily service-based economy, inadequate capital investment in the company, and even business failure, where some businesses just can never get up to speed quickly enough to get to self-sufficiency. And yet, even if we love small businesses and all the economic vitality they bring, we still don't want to take undue risk. So how do we know which businesses will ultimately thrive and which will fail? Today, we'll talk about two innovative ways that Experian is working to answer exactly those questions. One is pulling alternative lending product performance into our risk models. The second is using social media data to assess the viability of businesses. First, we will start with alternative data. Over the last several years, alternative lenders have grown their presence in the small business lending space. The traditional large banks, where I'm defining that as having over $10 billion in assets, only approve and fund about 27% of their small business loan applications. Credit unions and small banks do a bit more, 40% and 50% respectively, but alternative lenders approve and fund 57% of their applications, more than double that of large banks. Looking at the situation from a risk distribution standpoint, we might assume that larger banks are just more risk adverse, and there is certainly evidence of that. Looking at the distribution of the business owner's consumer risk scores, we see that traditional lenders have 79% of their loans in the prime and super prime segments. Only 21% are in the subprime and near prime segments. Meanwhile, 43% of alternative lender loans are in near prime and below segments, meaning that 57% of their loans are in the same risk space as the traditional lenders, prime and above. This shows us that alternative lenders aren't necessarily subprime lenders, and most of their new loans are actually to lower risk borrowers, just as traditional lenders are. They also aren't cutting out the higher risk borrowers, however. We do know those loans tend to have more expensive terms, and the borrowers do tend to be riskier relative to known risk factors like number of inquiries and DROGs. But perhaps there is a way to use this information to find the best customers even with a tighter credit policy. Traditional models have only included trade performance from traditional lenders and the business owner's consumer file. What if we pull in the performance information from alternative lenders as well? To test this out, we built a risk model pulling in alternative lender loan performance and compared it to more traditional consumer-only and blended risk models. As you can see on the left, the new model has a significantly higher KS than either of the traditional data models. As shown in the second graph, the lift of the alternative data model over the consumer-only model is 67%, and it's 43% over the blended model. Moving to the right, we see how it performs relative to other models in bad capture. In 10% bad capture, 20%, and 30%, the new model consistently wins, even over blended models, largely considered to be the best method today. The implications of this can have a big effect on your portfolio. Looking at this graph of the approval rate across the x-axis and the portfolio bad rate along the y-axis, you'll notice that at a 50% approval rate, or about that of small banks, we observe a bad rate of 4.3% for consumer-only models, 4% for blended models, and just 3% with our new model. This is just an aside, but one interesting thing that I love about this graph is that looking at the consumer-only model, which is still in widespread use in the industry, we see that there is very little change in the bad rate if we are approving 27% like most large banks, or if we are approving 50%. So it's possible that even with current scoring models, current consumer-only scoring models, there may be opportunity to expand without increasing portfolio risk. Looking at this the other way, if my risk tolerance is a 4% loss rate, I could approve 75% of applicants using the new model versus 22% for consumer-only and 49% for blended. As you can see, there's a lot of opportunity for better decision-making using a model that includes alternative data trades. If this approach is something that might be helpful to your business, we would be happy to help and talk about how Experian can help you build a custom model using this approach. Our contact information will be provided at the end, and we would love to talk about it with you. Now, moving on. Let's look at another way to get information about traditionally low information businesses using social media information. Let's say I have 3 gastropubs that have applied for a business lending product. These restaurants don't have much credit information on file, making it difficult to underwrite them. Some credit policies will simply reject these businesses because of this, but doing so is foregoing some opportunity. Looking at these 3 businesses, the first is on the way to decline, the second is going to have to undergo manual review, and the third is also on the way to decline. However, once we add in the social media data, we are able to finally gather enough information to make decisions. The first 2 are approved and the third is declined. As it turns out, this was a good decision because the last business listed here ultimately went out of business. In this test, we looked at 22 gastropubs in San Diego. 5 looked dramatically better with the social media view, 10 confirmed what we already suspected, 4 were much riskier, and 3 were no hits, but we were able to verify business activity using this data. This means that social media data could have made a difference in nearly half of the business decisions. Since this showed so much promise, of course, we built a model. Some attributes had a major impact on predictive models. Risk associated to the business category in the business trade area, risk based on the business category, average rating on social media over various time frames, number of days since the first review within the last year, and risk based on price level and hours of operation. We could also collect additional descriptive information, such as better detail on the business category and SIC code, hours, licensing, etc. Before moving on with the performance of the model, I'll note that this model score is currently available via batch append or API call. In a test of hit rates with this new method, we found very impressive hit rates with a variety of types of lenders, insurers, and telecom companies. These graphs show the type of business whose applicants we matched along the x-axis and the match rates along the y-axis. We divided the businesses into business category, and here we're looking at restaurants and beauty shops. Not surprisingly, those businesses that are more likely to generate online reviews and other types of social media presence were more likely to have hits and enough information to use. It is often just those types of companies that are difficult to underwrite: restaurants, healthcare professionals, and professional services, for example. So instead of creating overly restrictive credit policies for these types of businesses or categorically declining them, we can enhance the available information to a level that allows for a more rational decisioning. And finally, how well did we do? Quite well, in fact, particularly in those segments that are traditionally the most difficult, emerging businesses and thin files. Looking at this graph, we can see the lift over our baseline IntelliScore plus V2 model. Even in the segments that most lenders are most comfortable with, we see lift of 23 and 19%. And in those segments that are generally the most difficult to decision, we get very impressive lifts of 65% for thin file businesses and 177% for emerging businesses. To learn more about this score and how it might help to enhance your credit decisions, please reach out to us. As I mentioned, this score is already available and can be delivered either by batch append or API call. I want to thank everyone for joining today. You should now have a better understanding of how using alternative lending data and social media data can enhance the decision-making process for traditionally difficult to underwrite small businesses. For more information about what we've discussed today, please reach out via our chat link. I hope you'll also join us for more Sip and Solves in the future. As always, we welcome questions and requests for new topics.